What's going on, guys? Welcome into today's show. We've got round 2 of peace talks. The Iran-U.S. ceasefire setting to expire tomorrow. Markets responding. Retail sales came in. Is the U.S. consumer still as strong as everybody believes they are? We've got some home sales data. And are we starting to see some additional cracks in the housing market that could lead to something further? We're going to dive in on all of those today. Stay tuned. Well, Mr. Breedwell, welcome back. We missed you. Well, actually, we didn't. I missed you because I didn't get to go to the tournament, the poker tournament, charity tournament this last weekend. I was out in Arizona with my pops for a couple days, getting some good time with him. We golfed. Scottsdale was nice and warm, and we had a great time. So it sounds like it was a great overall charity event and great cause, helping out a young guy, right? Young kid that was going through some challenges.
Yeah, he had some medical complications where he has to have multiple surgeries, and so it was helping raise money for that and getting some financial relief for his family from the inevitable surgeries that will continue to come. So it's cool because I know right out the gate we had like about $15,000 raised.
That's awesome.
There's about 150-ish.
One of the things I love about charity events, because we're going to another charity event this week for ATOU, A Touch of Understanding, that my mom has been engaged with this charity for a couple of years, and we've gone to many of their events, and they go around and they essentially educate and provide resources in schools for kids with disabilities and helping teach other kids how to interact and support and understand what these kids with disabilities are going through. But one of the things I love about charity events is, one, you get to make obviously an impact in the community and the cause that these organizations are doing. And you get to connect and meet with so many other people that actually, one, generally are pretty affluent and successful and, have, great networks and resources themselves. You really get to expand your own network in the process and meet other people that have a heart that like to give and are also successful. So I was trying, tackle a couple charity events every year, and I was bummed to miss out Jocks, but excited for the one that we got coming up this week as well.
It's going to be really fun. We'll get to see Jock there as well.
Yep.
And I think that it's going to always give a good feeling to have fun, but give back at the same time.
Yeah, no doubt. Well, we've got obviously Iran, U.S. We'll continue to call up the operation because I think it's early next week or maybe this weekend that the official 60-day deadline, or maybe it's later this week, is expiring and needs to start winding down. We have the ceasefire that officially ends tomorrow. There was supposed to be round 2 of peace talks to kind of hammer out a deal by the end of today, tomorrow. In Islamabad, I think it was just reported this morning as we just got on here that Jared Kushner, Steve Witkoff, and JD Vance, who obviously were the delegation going to Islamabad to meet with the Iranian delegation, they're still in the U.S. There's no reports of the Iranian delegation showing up. Obviously, this has continued to dominate the headlines, and really the uncertainty in the market, or the uncertainty around where this is headed, is what's really created a lot of volatility in the market. So what are you seeing and hearing right now? What's kind of corresponded over the course of the last week? I mean, as of last week, when we recorded this at the same day and time, we were talking about potentially getting to you didn't want to say it out loud, your all-time high, 7,000 number. And then within hours after we finished recording, or maybe it was the next morning, it broke through all-time highs, even with the uncertainty around this conflict. So I don't know what to make of it. You do. tell us what you're seeing and what's kind of going on and transpired over this last week, and what you expect as we kind of come into the tail end of this deadline for the ceasefire.
I'm watching stuff go live. So apologies if I look like I'm going back and forth, because I have a live news feed going in front of me and I'm watching the markets as they roll. We're going slightly oversold right now, but essentially what we're seeing dominating the headlines is still the ceasefire agreement. Um, they haven't disagreed to having a ceasefire, just the specifics of the ceasefire have not, or well, the specifics of the kind of kaput have not been negotiated through. So that's what they're trying to figure out right now. Um, my anticipation is they're probably on the phone going back and forth right now, and both of them are using this as a posturing move to show strength. Again, Iran doing it just seems weird to me, because I don't I don't get it. They don't really have a leg to stand on. So to me, it makes no sense. Market's reacting in obviously a negative way, pulling back, continued on top of Monday's pullback. But we're looking at, 0.5%, a third of a percent. This may continue down to almost, 1%. But it's, the VIX is trading around 20. So just was trading in the high teens. I'm just not seeing the same volatility that we had prior. So I think traders are still betting on, as am I, the ceasefire being agreed to and continuing. Because again, we don't really have anything much more to gain, and they really don't have much more to lose. So I was telling you prior to the show, if we ultimately don't come to an agreement, it'll just make Iran look more like a North Korea. We'll just continue to blockade them and strangle their economy, similar to how we do the North Korean economy. So I don't really see a win for Iran minus bending the knee. Um, are they going to bend the knee? Well, we're seeing today they're pushing back quite a bit on it. Markets are moving choppy. It looks like, buying this minute, selling this minute, buying this minute, selling this minute. But I think people are just looking for clarity. It is overshadowing the good news that we've had on the earnings side.
Yeah, give us some good news.
It looks like we have, if I had my list of companies here really quick.
I know you had mentioned when we were chatting a little bit earlier, you had, what was it? We had
United Healthcare.
United Healthcare.
Earnings per share were around 723 versus 657, I think was their estimate. So a big beat, and they gave good guidance. They gave a really good profit outlook moving forward. The two kind of negative stories on the day was Apple announcing Tim Cook stepping down yesterday after market hours, and I forget his name.
I kind of knew that was going
John Turnus. John Turnus.
Yeah, and I think he's like the VP of software or hardware development. I mean, I know he's been kind of talking about this for quite some time, so I was a little shocked on a pullback on that news, knowing that most people that have been paying attention to Apple stock know that he was going to be stepping out at some point here in the near future. Maybe it was obviously to your discussion that we had earlier, they maybe weren't as hot or bullish or excited about this guy, but I can't imagine they'd be giving the keys to the kingdom to somebody they don't think is capable of, leading the charge going forward with, the juggernaut that Apple is.
I think that it's more so, I think it's two things. I think there's low favorability in the choice that was made. I can't ascertain why. But I think the thing that's more obvious to me is that um, what Steve Jobs did, and then eventually Tim Cook did, aka Tim Apple, I don't think the next CEO is going to be able to do. I think now people realize that Tim Cook stepping down may tell me there's a lot of wind coming out of the sails, and there's not as much octane or exciting projects in the pipeline to stick around for. And so to me, that's more so what maybe traders are ascertaining from the announcement. Not that he wasn't going to eventually have to name a successor. That was obvious. But that when he did it, it might indicate that that's because there's not reasons for him to stick around very much. So that's been the reason they're down over 2% today. The biggest miss that I've seen as far as in the earnings side is on Tractor Supply. Um, but their EPS is like 31 cents versus 34 cents expected. So a miss, yeah, but I guess by 10% ish, but not too crazy. Halliburton has been going crazy today. They had a really good earnings call, earnings beat in Q1. GE Aerospace isn't trending up, but their aerospace division did report good either earnings but bad potential revenue. 3M's doing really good. It's been a pretty good day across the board as far as a start for earnings season. But United Healthcare was probably the most important because of their size and the market cap weighting that they still hold, even with the huge pullbacks they've had over the recent year.
Yeah, I know we've kind of talked about that for some time, and seems like they've had a nice little rebound there. I saw that J.P. Morgan Chase released today their expectation of the S&P 500 target year, and they raised it up to 7,600. So
Now they're right. They're in my belly.
to your point, I mean, and it seems like overall, a lot of the big, institutions and juggernauts all feel like there's still plenty of room to run in the market. Now, we did see also today the retail sales came in strong.
They did.
Now, I know you mentioned maybe a little bit of that was due to gasoline and elevated pricing there. But another sign of the resilient U.S. consumer, right? March retail sales rose 1.7% month on month, surpassing the consensus forecast of 1.4%. So, I mean, overall, that seems to be reflective of what we're seeing in the stock market as well, correct?
Correct. The thing again that people are most focused on is the Iran stuff.
Yeah.
Because it's moving oil prices so much. But I think with the blockade that we have in place and how effective that is against Iran and the Iranian economy even further, I think that that's going to eventually squeeze us out a positive result. I'm not saying volatility won't come back, but I don't think we'll go back to where we were. If there is volatility, it's likely just a slight revisit to lows, but not new lows. And then I would agree with the large institutions on our way to higher highs.
Now, on that note, are we seeing or is there a threat of consumers running out of steam on and I'll give you a little bit of data of, where I've heard the other side of the street, which of course, we know the bears always love to paint a darker picture. That being said, the income side of the American household sector or the cash flow generation in real terms seems to be slowing or drying up in some capacity. We saw recent report says that nearly 40% of Americans have less than 500 in savings. Many are living paycheck to paycheck or working multiple jobs just to get by. 14% have nothing at all, and about 45% couldn't cover more than 1 month of expenses if their income stopped. 2/3 have already dipped into savings just to pay for essentials like food. We've also seen many take early. I'm not sure what the specific word is of like distributions, tapping into retirement accounts and things along those lines. And obviously, this is kind of in a time where we're seeing the quote unquote dollar weakening. We're seeing the uncertainty around the Iran conflict. We still got potential energy concerns. Affordability is still at an all-time low. So that, for a lot of people that maybe aren't in that upper echelon of, wealth or having reserves or having a really high earning income jobs, millions are kind of seeing their financial cushion either slowly deplete or it's already gone.
Mhm.
So is that something that could potentially snowball if some of these variables that are, there, maybe not necessarily creating the large headwinds that, could necessarily lead to something much larger at the moment, but are there? Are there any concerns around that, or do we still feel like those are just kind of, again, noise in the headlines and the consumer is strong and will continue to remain strong?
I think that the retail sales, if we were to take out the auto inputs, oil and auto sales, which are too volatile to be reliant upon, but are indicators that we use similar to headline and core on CPI. It still looked very strong. We also had a good employment change beat. I think there was about 54,000 jobs added versus about 30,000 or 39,000 jobs. So I think the consumer is stronger than the news is reporting. My opinion on what the news is reporting is it's somewhat negative, again, because a lot of the media doesn't like the current administration and they don't like the current conflict that's going on in Iran. But the thing that's going to happen is, and mark my words, we're going to pivot from this, and they're just going to pick up Cuba. I mean, the next thing they're going to start talking about is
I mean,
Cuba.
he already said, right? He's like, hey, we might, when we're done in Iran, we might make a little pit stop in Cuba on the way home.
Yeah, so I think the market's learning to digest this type of stuff, and Trump's doing a better job of navigating foreign policy than he did in his first administration. And so, I'm bullish. Shocker. But I'm bullish, and I do think that 76, 77 range on the S&P is realistic for the end of the year. Definitely quantifiable if things smooth out. And but we just don't see, again, the bear markets are more frequent, but the frequency is a trade-off for the longevity of them. So where they used to last, they would come every 2.5 to 3 years and last 9 to 18 months, you know, we get these pullbacks of, this, last year, 2024, early in the year, maybe some dips later in the summertime or early fall. And then sometimes we have a little bit of a volatile December and then we restart it. And it's looking like that's becoming the uh, more of the cycle that consumers are getting used to. And there's just way more retail traders now. That's just the difference of landscape that we're in
Yeah.
versus where we were. So,
Is that a good or a bad thing?
oh, good.
Good thing.
Yeah, it shakes out soft-handed investors on the front end, but it rewards long-term investors quickly. So you can quickly learn your lesson if you're there to learn.
Yeah.
People that are never going to change are never going to change, and they're
True.
always going to be,
Right.
you know, exit liquidity essentially. So I'm much happier going through a quick pullback like we have been, over a month and a half or 3 weeks, and then resuming a strong run versus going through, a year to year and a half like we did through the Biden administration. And that's just policy difference.
So, one sector that I noticed, and obviously I think it's apparent why. I was just curious. I wanted to get your take on it. I saw that the semiconductor stock sector of the market now represents a record 13% of total US stock market cap. And this share has more than quadrupled over the last 4 years. I think obvious reasons why in terms of AI and a lot of the tech, advancement that we've seen. I'm just curious, like, is that overbought? Do you think that the semiconductor sector really is one of those, parts of the market that people should be paying attention to? What are your thoughts on it? Wanted to get your take on that headline.
Yeah, we've owned exposure to it via a few different ETFs for years. Uh, the thing about the semiconductor space is it's going to be a required participant for growth in the whole AI, quantum computing, chip development domestically, all that sort of stuff. So I think that it's definitely not as early on as it used to be, but there's still plenty of room to run, especially in names that that are working on technologies or improvement to technologies that have yet to be announced. That's still out, in multiple different spaces, but certainly in the semiconductor space. And so, yeah, I'm pretty bullish on the space overall, and I think that people having it as a part of their core technology holdings is a pretty smart idea. We definitely do for a lot of our clients.
Now, what were your thoughts on this particular headline? Um, the stock market and consumer sentiment have never been this disconnected. And I'm going to just pull up a quick little chart here to kind of get your thoughts. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Amagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple. Focus on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. And whether or not there's really anything to read into here. So the University of Michigan Consumer Sentiment Index sits at its lowest level ever, while the S&P 500 is already broke all-time highs or, back near all-time highs. The current gap between the two is the largest on record, with the consumer confidence at levels previously associated only with deep recessions. By comparison, the Great Financial Crisis saw both metrics declining. This comes as the financial system is benefiting asset holders more than ever, while the middle class faces persistent inflation, muted real wage gains, elevated housing costs, and a weak job market. And I think that last statement is true, right? I mean, inflation in some areas for some people is still felt. There's not a lot of wage growth that people are really seeing or experiencing right now. Obviously, housing affordability is a major issue. I mean, weak job market, I think that's, I guess, relative from the lens in which you're looking at it in. But I think the biggest thing that I'm seeing here, which I'm curious on your take on, is it's really interesting to see, and this is why I believe, it shows how the psychology doesn't equal, the emotion that impacts the psychology doesn't lead to the actual result. Just because the media is pumping fear and there's all this uncertainty and doubt, if you're sitting on the sidelines worried about it, to your point, the people that, and I think I sent this to you actually last week, right? We were going back and forth on it. So this chart was pretty crazy. This was the last 10 days have been unlike, and this was when we hit an all-time high. I think it was the day of or day after the all-time high. The last 10 days leading up to that all-time high had been unlike any 10-day period in the stock market since 1950. The S&P 500 was up 9.8% in 10 days, which is in the 99.7th percentile of all 10-day returns. So to zoom out and kind of give a little more perspective on that, if you were 76 years old, you would have just been 1 year old for there being a market anywhere close, a 10-day stretch to being anywhere close to what the last 10 days of the market experienced last week. And so I think it's an interesting kind of comparison, right? To be all the people that have this really low sentiment and, perspective around the market and the economy, and we're heading for a recession and doomsday, 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 they just missed out on the best 10-day stretch in over 75 years in the stock market.
Yeah. And two things. I'll say something new and then I'll say something I've already said. Historically, and studies support this across the board, consumer sentiment or over aggressive pessimism in the market is an indicator that it's a good time to be in the market, because retail traders are terrible at trading. And over exuberance or over optimism is a sign that the market is probably in a position to pull itself back. So where we're at right now couldn't be better. If sentiment is low, that means it's probably a good time to stay invested. Not always, just as an overall indicator. And when we're looking back with 2020 hindsight, definitely not an indicator of future, but could be. And if it historically has, it might. But second to that, to your comment on the last 10 days, that's why you can't miss the biggest moving periods in the market. Because when you sit back and you try to say, oh, I know the best day, I know that today is going to be bad, so I'm going to sell. That also means that you know that when the best time to get in is. And nobody really knows that. And that's why it's so hard to time the market. So diversifying quality of investments, not over speculating, not chasing over exuberant returns and non-quantifiable things. That's what you really want to do. I'm looking for something really quick here that actually gives some data on, because typical rallies last about 10 days, recovery rallies. So when I pass it back to you, I'll try to pull that really quick, but it gives us the average rate of return a consumer can expect versus being out of the market and then getting back in right at the low.
And do you think that, when we see a historic, I'm curious, I guess, on what happened after that historic level 10-day return? Like, was it hey, this is the new floor and we're building off of this? Or was there a major pullback after that? I mean, I guess from everything we see in the market and what you're talking about, right, is that 10-day return, we're not expecting some, oh my gosh, this is the greatest 10-day stretch since, 1950. And now we're going to see, the floor drop out from underneath us and there's going to be some major pullback. This seems to be some, new kind of rung in the ladder that allows us to keep stepping upwards from what everybody else seems to be giving in terms of their sentiment and thoughts looking forward.
Correct. The study that I was just referring to was one that looked back from 2005 through 2024. And they have staying invested fully over that period of time with $100,000 of an initial investment in the S&P 500 back in 2005. Being out of the market 5 days, 10 days, 15 days, 20 days, and 25 days, and the difference in value. And what it says is the hypothetical $100,000 investment in stocks would have been affected by missing the market's top performing days over the 20-year period of January 1st, 2005 to December 31st, 2004. For example, an individual who remained invested for the entire time period would have accumulated $717,046.
Wow.
While an investor who just missed the top 5 trading days during that period would only accumulated $452,884. The difference there is almost $300,000.
It's a big deal.
Trader that missed 10 days, $328,505. 15 days, $249,335. 20 days, $197,114. 25 days, $158,792.
Wow.
That's the point of staying invested. And a lot of people say, oh yeah, I have an advisor. And I can't tell you if they're good or not, but every time there's market volatility, they tell me to just stay the course. It sounds like they know what they're talking about.
Yeah.
That's what the data says to do. And people think we're just saying that because that's the record we like to play. But that's literally because that's exactly what the data says to do. And asking me to know when the bottom of the market is.
Come on, man. Where's your crystal ball?
No matter how, I got it right here. No matter how good I am at getting pretty close to calling them, I have been in the past couple years, which is kind of dumb luck. You have to stay invested.
Yeah.
You just have to. It's part of investing is going through volatility. And the data shows us that because we've had some of the worst. 2000 to 2010 was considered the lost decade for investing. It was a terrible decade to invest. There was 6 really out of the 10 years that you would have taken massive losses in an equity-focused portfolio. So it's not like it's been a sunny time, but you could have 7x your money by not doing a damn thing. It's quite literally that easy.
Yeah.
That's no contributions. That is dividends reinvested, money in the bank, riding the market up and down and just leaving it alone.
Yeah.
So again, when we set up financial plans, it's a very big thing to stick to the plan. That's why when I do it, I show people, look, 1, 2, 3, 4, 5, 6, 7, 8, 9 years of losses over the next 23, and look at how much money you still have. It's going to happen. Don't worry about it. It's going to happen when you're retired. Don't worry about it. It's part of the process.
Yep.
If it wasn't, everybody would just be like, oh man, I'm just going to go ahead and stick all my money in the market. That's how easy it is.
Now, I know you're not giving any financial advice here. I'm curious, I've got some pre-IPO shares of Anthropic. I saw news today, President Trump said we might have a deal with Anthropic's Claude AI. Amazon just noted that they're going to invest $5 billion in Anthropic, now with up to another $20 billion tied to commercial milestones. I know Anthropic kind of talked about committing to spending more than $100 billion on AWS, and there's this kind of incestual connection, but they're IPOing, supposedly IPOing this year in 2026, filing. Any thoughts on Anthropic or just in general, certain AI companies that you're paying attention to that you like? I know OpenAI kind of is hot one day and they're bullish and excited about OpenAI, and then they're concerned about Sam Altman and they're concerned about kind of the economics behind OpenAI. So I'm just curious on kind of what your thoughts are, whether you want to speak to one, multiple, or just kind of the big AI juggernauts in general.
Yeah, I think that I think that anybody who can figure out how to push forward, I think it would be a SaaS product, software as a sales product that can enhance sector, financial, technology, healthcare, communication sector. I think they're due for a really big run. We have so many names right now, it's almost overwhelming. So I don't know if I could really pick one. That's not really my game. But I think that any of the really big ones that are going to have a lot of quantifiable performance to be had are going to be ones that have partnerships with a lot of big technology companies. I think they will try to get equity interest in these companies pre-blowing up, and they have a lot of experience and know-how to identify those, being that that's what they kind of do. And so I would say that those would be the indicators that I would be looking for. Well, I would like to follow other successful companies in the space, putting their money into that before maybe I did, because that would be hard to identify pre IPO or anything like that.
Yep. Cool. Any other stocks or sectors that are on your radar? And again, no financial advice here, more so just things that you, as someone who loves to study the market, study businesses, study sectors that you're thinking is maybe undervalued, or that you're just very interested to see how things play out over the next quarter or two with?
I think healthcare has been a dog for a while, and that's going to probably have some upswing here. I definitely think that energy is probably going to be a rotate out area here in the next coming weeks. when we do find some clarity forward with the Iran situation, and I think people are going to get back into tech and maybe financials as well. But healthcare would be the one that I would be looking at, because it's not done so well, and I think AI has been underused in that space, and the value that can be added to the healthcare space with AI, I think, is fairly substantial.
Yeah.
So that to me would be the area I would look for the next kind of unicorn to pop out. I don't know how soon, but I'm pretty
Healthcare.
sure that would. Yeah, I'm pretty certain that that would happen.
Well, did you see, I mean, I know we've been talking a little bit about, there's going to be more and more one or two person billionaires that are, billion-dollar companies that are created. You saw the guy and his brother that were basically vibe coding and created like an AI telehealth company that I think has like, it's just the two of them and a bunch of AI agents essentially. And they were pushing, some kind of health drug, call it, um, and, got their revenue to like a couple $100 million within like 18 months just using AI agents.
Mhm.
And there was kind of a big article breakdown around more and more of these companies going to be popping up for people that are tech friendly and understand how to leverage AI and LLMs and all that kind of stuff, but specifically in the healthcare space. And so, I thought that was kind of an interesting breakdown. Now, as we wrap up on kind of the stock market, I just wanted to make this note here that the world is still betting on America. Demand for U.S. assets is extremely strong. The number of days with U.S. stocks, the U.S. dollar, and bonds all declining simultaneously is down to just 9 in 2026, on track for the lowest annual reading in 11 years. So, in spite of all of the crazy news headlines and concerns about America and the dollar and all of this kind of stuff, by comparison, the 1990s saw 30 to 60 such days per year, with the peak at 62 in 1994. And you correct me if I'm wrong, but the 90s era was a pretty darn strong decade for the US stock market, correct?
Was you can kind of buy anything equity focused to make money.
So if you compare those 2 decades, right, and we'll just say this year and the average of what we saw in that strong decade, pretty big delta there. In 2025 alone, foreign investors purchased a record 1.55 trillion in U.S. financial assets, according to the Treasury Department, and as a result, they now own 21 trillion in U.S. equities, which is an all-time high. So
Yeah.
the world, no matter what you want to say about our allies or how people feel about this administration, money talks, and people and companies and governments still feel very bullish on the future and just the security and safety of their dollars being parked in American companies and assets.
Correct. We are the world financial power and the world military power still currently, and I don't see that changing anytime in my lifetime.
Yep. As of today, Bitcoin is, still chopping around. It's, I think, chopping around between 74 and I think last week was a high of 78. It's still kind of in this overall channel that is probably pretty similar and following the stock market, right? Just kind of, rising with good news, little pullbacks with bad news, but still kind of stair-stepping back up from, I think it's recent low of in 2025 or 2026 of 60,000. And obviously, I think there's still a little bit of room for it to maybe have some additional pullbacks. The altcoin market and all the other kind of secondary coins, I think, are all just very reliant and waiting to see what happens with Bitcoin. Now, we did see the housing market, while it did post pending home sales were a beat, the metrics still aren't that great. There were an estimated 46.3% more home sellers than buyers in February. And, I think this is, again, not to beat a dead horse on this particular narrative, but the overall economics in the housing market and just, the incentives and affordability for buyers to really want to jump in is just not there. And the housing market is seeing that with the lack of demand on buyers. There were an estimated 46.3% more home sellers than buyers in February of 2026, which was the biggest difference since Redfin began collecting data in 2013. This gap has widened sharply from 29.8% a year ago, making the strongest market for buyers in over a decade. So if you can afford right now, there's a lot of inventory out there to negotiate and to, get what it is that you're looking for, and obviously have the opportunity to refi at a later time. By comparison, there were a record 36% more buyers than sellers in November of 2022. This comes as the number of active home buyers fell 2.4% month over month, which is the lowest since at least 2013. At the same time, the number of sellers declined just about 40 basis points month over month, posting a smaller decrease than home buyers. So further home prices, coming down, cuts, more incentives, in my opinion, are not only here, but I think they're going to continue. And this is a great thing if you're somebody that's looking to get in and buy your first house. If you are looking to pick up some rental properties, again, and I think we brought this chart up a while ago of like the performance between real estate and the stock market. That the stock market really has kind of crushed real estate in a lot of capacities over, I think it was like a 50-year time frame or something like that. But again, as we always talk about, real estate and stock market, investing, I think has a very, very good complementary advantage to one's portfolio. And they really kind of offset. I mean, look at the stock market's at all-time highs, and real estate's kind of been in the shitter for the last, couple years. And when, we were seeing the stock market hit some volatility, a few years back, real estate housing was ripping and going crazy, right? So I just really think that, looking at these, meeting the market where it's at and looking at these times as an opportunity to find something that pairs well with your investment goals. Doesn't mean you need to go all in on real estate right now or all in on the stock market, but just using these times as an opportunity to, take little bites around, assets that are showing some alpha that can be gained over time if things are a little bit undervalued right now. And you mentioned it a little bit earlier, right? Like it being somewhat .com bust-esque feeling in the housing market.
Yeah, I just feel, except it's not like value depreciation. It's like it's access to capital or cost of capital. So it's just how the barrier to entry has been just high for a lot longer than I have anticipated. Or I think even we both did anticipated. It's just not how it usually works.
Yeah.
But again, to your point, what you just said, that's why being diversified in your asset classes is good. That's why real estate investors should still have a good stock portfolio. And why people that have a lot of investments in the stock market, if they feel like doing the work or paying somebody else to help them do the work, they need to be in the real estate.
Yeah. Yeah. I mean, it'll be really interesting to see how things play out, right? If we continue to see the market hold steady and strong, I think we'll see, a pretty nice recovery in the housing market and some pickup in demand when rates, get cut. We also know that Kevin Warsh was kind of going through his confirmation hearing today, I believe in front of Congress, and getting grilled. And, of course, he knows that Trump wants rates lowered. He also noted, hey, I didn't commit to anything to Donald Trump, and I still believe in keeping the Fed and administrations and politics and separate. You can take that with a grain of salt. I think there's obviously some, influence there, but if we don't see things improve or we see some additional headwinds come in, I think it could create an even bigger pressure on the housing market. We've seen that existing home sales have dropped, in a pretty significant way from the peak. They're down 35%. So that's a technical demand crash in terms of buyers just really stepping to the sidelines. And then obviously with inventory really picking up, we know the supply and demand curve drives a lot of what home values do. And overall, they haven't seen too much slippage, even with supply increasing and that demand, dropping off. And a big part of that is, I think, due to the amount of people that are somewhat trapped in their homes. I mean, imagine buying a house in 2022, and now you've got builders selling the same home with lower prices. They're offering, 3% mortgage buydowns. They're giving incentives. That means that a lot of those people are sitting in instant negative equity, and they are at higher interest rates. So they can't really do anything. And then when you look at all the people that had 2.5, 2.75, 3, 4%, interest rates on their homes, like they don't want to trade out of something to go and get a 6% interest rate. I think right now we saw the average 30-year fixed mortgage rate as of yesterday was like 6.3. Same time last year was 6.87. So, I think it's one of those things where we have a lot of lack of urgency or incentive to want to do anything right now. And so the people that do have their houses on the market, they kind of need to sell in some capacity, which gives the buyers all the leverage. So the pressure is quietly building beneath the surface a little bit. And if we see unemployment rise, if we see real distress start to hit, I think we're going to see a lot more forced selling, which is going to really shift some of the economics and values in the housing market. So, there might be a little bit of cracks there, but the real pain hasn't started yet. And I don't think it will unless we see something much larger in the overall, economic landscape here going forward. Now, I will say this. I saw this was an interesting headline. We can wrap up on this. Tenants are starting to negotiate. They are literally emailing landlords saying, Zillow shows cheaper homes nearby. I basically want my rent lowered or I'm moving. And we're starting to see landlords increasingly say yes to some of these demands because they don't want to lose income. They know there's a lot more housing supply out there. And we're seeing that in the economic data with rents starting to pull back in certain markets. So again, really interesting times. Do we have the crystal ball of where things are going to go? No, but we can at least look at the data and kind of say, hey, what's the market telling us? Where are things right now? And where, if these trends continue, are they going to go? Or if these trends, go in a different direction, where are they going to go? And that's all you can really do. So as always, we appreciate you guys tuning in. If you want to connect with Ryan and his amazing team, text the word X-ray to 844-447-1555. They'll do a free workup, deep dive into your portfolio, something that he's done for many of our amazing Millionaire Mindcast family. If you are an investor, you're looking for passive income, getting paid like a bank does, my new fund is officially launched, Boring Income Fund. No syndications, no beautiful, sexy promises on IRRs and pro formas, just first position collateralized asset income paid out by being the bank with me. So if you want to know more information about that, text the word income to 844-447-1555. As always, we appreciate you guys tuning in each and every week. We'll see you guys in next week's episode.
Cheers.